On? Okay. All right. Good afternoon, everybody. Hopefully everybody was able to get a lunch, and we got probably a relatively meaty topic for right after lunch, capital for insurance companies. And so let me introduce myself. My name is Chris Fries. I work at Principal Financial Group here in Des Moines. I am an actuary by trade, been with in the financial services industry almost 30 years now. Work for Ken McCollum, who you met this morning at the CRO roundtable. Let me introduce our distinguished panel here today, experts in the field. So to my left here, we have Brian Spadaccino. He's a director in Aon's Capital Advisory Group. He is responsible for advising clients through rating agency criteria and capital management strategies. Brian's prior experience includes time at S&P Global and AM Best, where he focused on life and annuity and property casualty portfolios. To his left, we have Dean Crabtree. He's an executive director at JP Morgan Asset Management with our Global Insurance Solutions Group. Dean is the global head of investment accounting and regulatory reporting. Dean has 25 years of insurance financial services industry experience. And furthest down the aisle here, we have Mike Janacek. He is the chief actuary at the Iowa Insurance Division. Mike serves on a number of NAIC task force and groups, including the Life Actuarial Task Force, Capital Adequacy Task Force, Valuation Analysis Working Group, among others. Are there any others? Previous to his time at the insurance division, he worked at a life and annuity company and is a Drake alum. So welcome to all three of you here today. And so we want to also make this session as interactive as possible. So to the extent that you have questions along the way, we'll try to get those folded in. So certainly feel free to raise your hand, and we'll try to make sure that those online hear the question as well. So with that in mind, I will get us started. With capital models themselves, there's a lot of different, it's an alphabet soup in terms of different agencies and regulatory bodies that have capital expectations for insurance companies. I guess with that in mind, I'm going to start with Brian. With respect to S&P, can you level set for the group, what's sort of been going on there? They've been in the news quite a bit over the last year in terms of how they're looking at capitalization.
Yeah, sure. Thank you. So S&P, as some of you may be aware, in 2021, end of 2021, they started this process to put out an RFC for updating their capital model. It's a messy process. It's still going on. Will continue to go on into 2020, mid 2023. So you're looking 2021 to 2023. This process has been going on. A lot of the changes are needed and well-intentioned, but there was a lot of pushback from the market. And some of them were not analytically sound in the approach. So we've seen various constituents come out and a lot of stakeholders, whether it's the private equity industry, insurance companies, regulatory bodies, come out and voice a lot of opinion about the changes that were proposed. With that being said, changes are necessary. There needs to be an update to the model. It's a little stale, but how companies react to it is the most important part. And what we see is that with these uncertainties going on and the fact that we still don't have a capital model from S&P, companies are finding it difficult to manage through the process.
Thank you. Mike, maybe just down to you real quick here from an NAIC RBC perspective, which I guess would be your lens. We've seen some recent updates. Last year, there were some updates to investment factors and such. Can you talk a little bit about what else is going on in terms of maybe RBC hot topics and maybe even group capital? That's been out there for quite some time.
Sure. First off, I guess to hit group capital, I think everybody who wants to know about group capital has an understanding of it of some sort by now. The group capital calculation was a very contentious build for the regulators and for industry to assist with. But the current issue, as I understand it on group capital here in the state of Iowa in particular, has to do with when it must be reported. And, it is part of the Holding Company Act, and implied in that it's due in, I believe, March March 22 would be the first one. Pardon me, March of 23 for year end 22 would be the first time a group capital calculation is expected to be done. Industries reached out to the insurance division. We're very aware that companies are finding that to be an awkward lift, and they'd much rather see a June 30 type effective or due date for that. As such, we believe that industry is going to bring legislation here in the state of Iowa officially after the session begins in January. And, from an insurance division perspective, we don't have a concern about that being backed off. We primarily use RBC. RBC was built for the purpose of identifying weakly capitalized companies, and that's what we're in the business of doing. The GCC is more of an accommodation for international regulation and comparability at a higher level. So it's got value, but we don't have a problem with the date being backed off. We don't anticipate having any concerns to be voiced or anything. And we figure that it probably will get backed off to June 30. That's probably the most current item that I see for any sort of capital calculation on RBC, or pardon me, on the GCC. On the RBC side, I spend most of my time on the life RBC in particular. We've got a few items in life RBC that need to be addressed. One that's come up in the last year and a half, well, mostly since about March of this year. We talked earlier sessions that interest rates have been rising. I think everybody's well aware of that, 4.25 today on the 10-year, things of this sort happening. There is concern in industry about calculating the capital component for C3 phase 1, and the fact that that modeling that's required for that does revert to a long-term mean that's even much higher than where we are today. It goes to a mean, I think, over time of like 655, and that is not necessarily appropriate. So there is discussion. It hasn't been official and public on calls yet, but there's certainly discussion between regulators about the fact that we do need to get on the record very soon that we need to look at updating the scenario sets that should be used for C3 phase 1. New York has suggested the idea, I believe it was New York, suggested the idea that maybe we just mandate using the VM20 scenarios for now as a stopgap, and that might be one solution. They had said that on a call maybe 2 months ago or so. Certainly that has feasibility, but that's another item in particular with where the economy is and where interest rates are. That's very top of mind for me in discussions.
Great, thank you. Dean, from the question was, what would the period be applicable for any changes to the C3 phase 1?
Well, since it hasn't been officially brought forth in a public setting, and there was a Life RBC call just this week, and it was not on the agenda, it's difficult for me to guess. I think it needs to be in as soon as possible. I know that that's the opinion that, like I said, New York had stated was that they'd like to see a change. There's other regulators who have hinted to me that they'd like it in as soon as possible. I don't know if that can be done for year end 22 at this point in time, but I have had companies who've raised the issue to me about the fact that there's a real issue there and we need to look at it. Pardon me, let me back up. When I say there's a real issue there from their perspective, they're speaking about the real issue of what's required by statutory. They're not necessarily speaking of the economics. They're trying to hedge and run their companies on an economic basis, and they feel that this modeling for capital might be causing some problems that is not necessarily economic, and that's the real issue. So I'd like to tell you we're going to get something done very soon, but it's a matter of getting it on the agenda and getting the chair to want to talk about this and come up with a real solution. And we haven't quite bridged that gap getting there, though.
Thanks. Dean, from your seat, anything that you're seeing with respect to all the capital model evolutions and things of that sort that are on clients' minds?
Yeah, they're evolving. I think, when we talk about capital modeling, you kind of look at each insurance company and you kind of say, what is a constraint that you look for? Is being capital efficient and, boosting your RBC one of your primary constraints, or are you focusing your company a little bit more? Certainly on the property casualty side, we see a lot more of our clients say we are more concerned about liquidity, shorter duration assets, which then kind of takes away a little bit from the RBC. Typically on the life side, certainly a lot more focused on the RBC. So, there's kind of a couple ways to look at it when it comes to how you think about your individual company and how RBC applies to you. There's several factors you always have to think about when you run a company. At the end of the day, you've got to be able to pay your policyholders. That's first and foremost. RBC is a byproduct of the solvency of your ability to do that. You've got to be profitable. RBC is also a byproduct of that. So when you look at all the other factors that come in, RBC is a function of asset class, regulatory rating agencies, things like that. There's inconsistency just inherently in how rating agencies rate assets, the frequency of which they rate the assets. You know, the S&P capital model looks at S&P's rating, doesn't really give the same favorable treatment to any of the other rating agencies. So there's this constant struggle as far as, you know, evolution is a really good word to use as far as at a point in time between when the regulators are looking at it and what gets, you know, ultimately adopted versus the various versions that it goes out to the market to find and kind of says, you know, give us public comment, tell us how you like this model, tell us how you don't. And, you know, that process typically does not happen overnight. It goes through several reiterations, and you've got the credit rating agencies. So it really is kind of an evolving metric. Assets are evolving as well. You know, not all assets function as a corporate bond. Some companies like to create an asset that actually becomes RBC friendly, then a regulator might look at it. So there is a changing evolution that constantly happens, and it's basically you pick a point in time that becomes your RBC for your annual statement year, and you kind of have to live with where that falls and kind of the equation of everything else that's going on.
Thank you. Actually, that was a great lead into my next question here, and the theme.
You can pay me later.
The theme is sort of the drivers of change. And so, you know, I guess I'll just start with a observation. I think you already confirmed this a bit. Is you know, there's been a lot of innovation with investment strategies out there at times, and using my words, many times we're trying to outsmart the capital models, as it were. But maybe I'll look at the end here to you, Mike, is to start with is. You know, so you usually see a lot of these strategies potentially in your business. Are the risks of the investments being reflected in the capital requirements today? It may be not at that specific level, but if you look at the total capital that an organization holds, you know, is it hitting the mark, or what are your thoughts?
That's a great question. And this is the neat thing, goes back to part of what Ken McCollum had said earlier today about all models are wrong, but some are useful. Very common quote. And yes, the capital models that we use most are US statutory. That's ones that but you know, there's a lot of reasons and issues that come up and are brought to us because of other capital models that companies use as well. But just looking at how we use the US statutory framework, it will continue to evolve. Certainly in the asset area is one of those spots that evolution will continue over time. But you know, it's still a model at the end of the day. And it's the best tool we've got to understand the risks inside of a company and how strong that company might be to take on some of those risks. There are other risks that have gotten attention in the last few years that were at some level completely ignored. One of those would be longevity risk. That had been completely ignored for a long time and only gathered in an overall other type category at best in approximation. So yes, I think you'll continue to see some evolution in the asset side. And I think because of that, there will continue to be evolution of the modeling requirements put on those assets. But at this point in time, I would say that the RBC framework that we have is suitable today for the job we're doing of identifying the most weakly capitalized companies that need to have our focus and our attention. That's not to say, though, that you can use just an RBC ratio to compare two companies and say, oh, this one's got 425 and this one's got 415. There may be some things that are happening between the two that are a little bit different. To me, the difference between a 425 and a 415 is, first of all, 10, but it's not meaningful if you're managing a company. And I don't believe that most company management teams are concerned about that. They've got a number that they want to stay north of. And this is just part of the regular conversations we have with companies when they're giving us annual or quarterly updates about, you know, okay, your pro forma right now for year end 22 is saying you're going to end at 415. Where is that compared to your target? I want to make sure I understand how you're viewing it at your company, your management team. Is that something you're comfortable with? Or, you know, are you trying to hold higher than that for a particular risk you have, or because you're trying to achieve an upgrade from a rating agency or something? We want to see where it's at. So there will continue to be evolution, but I don't see a need for anything drastic, and I don't see any gaping holes that invalidate the modeling work for the capital models.
Great, thank you. Brian, from your seat, as you talk to
Yeah.
clients?
So, I mean, what we see, and everybody's using the word evolution, that's really what's going on. Regulatory frameworks, rating agency capital models, they always lag in innovation, right? So we're in a period where regulatory capital models, rating agency capital models are trying to play catch up. And it's really focused on two elements. One is updating existing risk factors, right? Some of these risk factors have not been updated within 10, 20 years, right? So updating them for existing recent experience. And so there's not necessarily an issue with what the model's trying to capture there. Then there's a second component, which is an introduction of new risk measures, right? And trying to quantify new risks. Longevity risk, for example, is one of them. Longevity risk is becoming more present within the U.S. on U.S. companies' balance sheets as the private sector shifts pension risk to the insurers. So longevity risk is an introduction, whether in the S&P capital model or the NAIC RBC model. And then there's a change in how we measure risk, as we were talking about asset risk is a big focus. Technological advancements in how securities are packaged, right, is driving a lot of that. So we've always measured asset risk, but now we realize maybe we need to take a more principle-based approach. As Dean said, you know, a corporate bond default factor, we can't just apply that to a structured security. You see cash flow modeling for CMBS done at the RBC. So we see these changes going on, and the rating agencies are kind of mirroring what is going on at the regulatory level. And the question is like, how clients adapt to it, right? And that's where we see some of them with a lot of this uncertainty on where things go out. I say this consistently, you know, it's this uncertainty, this overhang that is creating some issues for companies, because even if there's an issue, like they disagree with how a capital model is, if they know what they're being measured by, they can manage to it. But that's not occurring.
In terms of, you know, maybe getting into, you mentioned S&P a couple times, Brian, but maybe just for the widen this out a little bit, Dean, you know, there's been a lot of reactions that we've seen in terms of that request for comment, and it's got delayed. Maybe just open it up to the group here, but there was just a number of comment letters made. Maybe the first question, did anybody see any that were in favor of the changes that were out there?
S&P employees.
Okay. Okay, that's about right then. But just maybe just generally, you know, what was the general theme of some of that feedback that people were seeing? And
Yeah, and I'll start first. I mean, at Aon, we work with clients and them crafting their feedback. We provided feedback as well. And I think, like, aside from that feedback, we think some of the changes were well intentioned but the way they went about it was wrong. We do think, or there is a concern about ratings. And how securities are rated by the NSRO. So the idea that a AAA at S&P is the same as AAA at Kroll, there is a level of concern there. But the biggest issue was that it was very clumsy in their attempt to quantify that change. And that's the biggest issue that we felt and was a consistent thing. I mean, the asset risk charges that they went about was the biggest issue that companies had. Treatment of debt at the holdco, some other things. And so I think what you saw happen with the S&P capital model was there was good things to come out of it, and the direction was right, like the mechanics, increasing diversification benefit, updating risk factors. It was well intentioned. However, some of the changes were, you know, beyond that, were just so far off base that it was better to stick with an old model that maybe wasn't as effective and efficient than move to this new proposed model. And it was just the asset risk charges were a consistent theme. And what we hear from clients is there is a difference sometimes with you know, the rating of bonds, but not in the case of S&P was to treat them as CCC, structured securities, to treat them all as CCC, irrespective of, you know, anything else. It was just lowest common denominator. And that was the biggest issue. Lack of thoughtfulness, I'd say.
thanks. Mike, I saw that the NAIC had a comment letter that went to Congress, the Banking and Finance Committees, just in terms of it was out of character, if you will, for NAIC to probably comment on what a rating agency approach was. Any perspectives to that you had or you can share?
Okay. This is going back to a conversation I was having just last night with a friend. The capital models that a company uses are extremely important because they paint the picture for how they view a lot of their organization and the risks in their organization. Statutory capital, for example, was not designed for that. Statutory capital is designed for regulators to get a good idea for the risk level and the capitalization level of a company. RBC is being maintained and updated for that purpose. It's not necessarily being maintained and updated for the purpose of management being able to effectively manage their organizations. That may be a spot where there may be some shortfalls from time to time in how that model is used. But that's the great thing about models. Some are useful. If you're going to use it for if you've got a model and you're not using it for the intended purpose, you really got to go back to basics and see, is this the right model to be using? I get questions as a regulator that are brought up frequently by other capital models that companies are using. And I'm not talking about homegrown capital models. I'm talking about issues that arise when somebody's looking at how something is treated on a Solvency II basis versus on an RBC basis, or how it's viewed, what's happening to a company's BSCR ratio out of Bermuda versus what's happening to their RBC in the States, or what's happening on a GAAP basis. I mean, whatever model you're looking at is going to color your future. Those who are using multiple models, maybe they're doing things, maybe it's just a public company. They're doing GAAP and they're doing STAT. Okay. There can be some informative knowledge gained from that can be useful as they're trying to make strategic decisions within their organization. So to me, I can appreciate someone wanting to comment on someone else's capital model. But once again, an AM Best capital model, it's not necessarily made for company management. That's made by AM Best for their use. And I think S&P would be the same way. And I think Solvency II, just because of a different view of the world, held by European regulators, is going to be different. So to me, I think we can learn something by looking at how things are modeled or how they're approximated in other capital modeling bases. And I think that can be very useful. And I think that's where we can get some good ideas for the evolution that we each need to have and what we're using our models for as the designers, if you will, or the maintainers of the model. But, it can be tricky, particularly when you're a chef in somebody else's kitchen telling them how to cook the soup.
Well said. Well said. Maybe sort of switching gears a little bit in terms of, with your client interactions, just general advice you're giving back. We've talked quite a bit about the uncertainty and, changes of foot. And, I think Dean, you sort of referenced, money's got to get put to work. Just, what's the conversation? What kind of conversations are you having? And, is capital even on the radar screen?
Yikes. But yeah, there's this is, an unusual time in how you put your money to work. There is probably more uncertainty around how money can get put to work, where it should be put to work, and if it should be put to work now than ever before. When you look at what's going on in the world, you've got a war that was not supposed to still be going on, that has largely impacted several commodities, the trades, the future of what we leverage coming out of Russia, coming out of Ukraine, what we can rely on them for, energy supplies, things like that. You've got midterm elections, which Lord only knows where that's going to go. You've got increased concerns with China and what we're going to do. Are we going to become friendly, open up trade with China again? We've got a prime minister in Europe that has now just resigned. You have just got what I think is unprecedented uncertainty that makes you wonder kind of what's next. And this kind of seems to, and by the way, there's a slight thing called inflation going on right now. It's just really tough to figure out how you run your own business. And, to the point about the capital models, what we see a lot, and insurance is a global industry. It's not, US only based. It's not Bermuda only based. It's, reinsurance. It's a really interesting total picture. And what we find, at least specifically for capital, is companies are coming to us, and we have a team that does this and does it very well. They have all the capital regimes, and they say, where's the best place to park an asset that is capital friendly? Do I put it in my Bermudian company? Do I put it in my European entity? Do I put it in my US company? So, there's so much going on that when it comes to how do you pick an asset and what do you need that individual asset to do? If it's liquidity, that's one thing. If it's capital preservation, that takes on a completely different meaning. So I really just think it becomes, to this panel's point, is how well capitalized are they? How can, and among other things, Florida's kind of got a little bit of a mind of a lot of property damage. So when you put all those things together, it really becomes what is specific to the insurance company, what are specifically they underwriting, and what are they specifically trying to achieve. And that's kind of how they're determining how they're going to put money to work, where they're going to put it to work, and kind of to what level they're going to put it to work. We are certainly seeing more liquidity coming into the space. People are kind of saying we don't want to lock up our assets. We want to be able to get it cash if we need it. So, I think there's just an unprecedented amount of global uncertainty that, frankly, it's a little concerning to some.
That is sobering.
Sorry.
No. Brian, anything to add from your seat?
Yeah, I mean, there's a lot of uncertainty, a lot of changes going on in the world. This is why, and it's important to have a good ERM program. I think this is, we talk about capital model, and there is this model risk, right? These are things that companies should be thinking about, and they should be thinking about when they're designing their ERM programs. We're telling clients, especially as it comes from a capital modeling perspective, engage early, engage often, understand what the impacts are of the changes don't wait until the capital models are finalized. Participate in it when you can with the NAIC. Reach out to your regulators, right? Reach out to your rating analysts. Understand the impacts, models. Understand what the impacts are on not just one specific asset class, but gross required capital, net required capital. What are the diversification benefits? Because a lot of that will, one, it's a good ERM exercise to go through. Two, it'll help understand the impact on your company, and it takes time to react to these changes, right? A lot of these companies are large. We have large clients, and it takes time to make significant changes to adapt to what's going on in the marketplace or changes in capital models. So it's just, there's a lot of action plans that need to be implemented when things come up, and we're telling clients, don't wait, get started and understand how it impacts you.
Great advice. Mike, I know you're not necessarily in the business of providing advice, given who you are employed by, but you probably also have behaviors you want to see maybe possibly change. Is there anything that sort of comes to your mind in the space, or you feel it's pretty well managed?
Probably the biggest thing goes back to knowing the model that you're using, what it was designed for, and is it still fit for purpose? And I guess we just spoke briefly about ERM and risk management and the modeling used in that. There's still a lot of room for improvement in a lot of companies modeling. It might be around operational risk, or it might be on something that's not directly a financial risk that they've been modeling or having controls for 80 years or more. It might be something that they just try to do well, and you never want to admit to a problem, but it comes up and they've never really modeled or gotten a grasp on how volatile that risk might be and what it might actually mean to the organization. And like I said, it could be something as simple as operations risk in certain areas or aspects. But these models need to be just like any model. You can always make improvements. You can always add features to it. You just need to make sure that, is it worth the time spent? Am I getting something that's going to actually be better, easier to maintain, or more accurate in a portrayal of a certain risk factor? And there's, there are companies who are working hard on that, because they're, the focus in the last few years for a lot of companies modeling has been on improving their capital model internally for risk management purposes and for filing in ORSA. But every once in a while, I will hear about from other regulators or see myself a filing that, isn't necessarily on a consistent basis. They might say we're doing our modeling on a statutory basis. That is the underlying basis we're using, but some of the modeling that they're doing for some of their risks isn't necessarily statutory. So you're trying to make a conversion over. How does this translate? All of that can be fine because it can provide insight. Just remember that, anytime you're touching a model and updating it, you want to keep track of the simplifications you're making, because at some point in time, that may no longer be appropriate. You may need to go back and update that or pull that particular element of the model back out if it's just not reasonable. So to me, it's the care and maintenance of the model. It's something that does need to be watched out for, because it happens frequently that people are like, well, we've got this model, we can use it for that too. And well, it might fit, it may not be fit for purpose. You have to look at these things and just be careful with what you're using them for. And then that's part of goes back also to what I was saying earlier about, I really appreciate it when people are looking at their organization through two different lenses at least. Whether that's a statutory and a Bermuda model, or if that's a statutory and a GAAP or whatever it might be, there can be insights that can be useful there, particularly in risk management and making risk and calculated decisions. So that's a spot that I think always is going to need some emphasis, is just taking care of the model, because it's the best picture. It should be the best picture you have of the reality that you're in. So it can be the most useful tool then to figure out what might be changing, what might be coming in the future.
Great, thank you. I guess the next chapter here I want to talk a little bit about, and Dean touched on this a little bit, on the macroeconomic outlook and some causes for concerns. And I think, Dean, you rattled off quite a few that are going to keep me up a bit here at night. Maybe just flip the question around a little bit. Are there things that you're looking for as potentially the green shoots of where we're coming out of the other side of this? Anything that sort of comes to mind?
If I was good at forecasting, I'd be an actuary. I think it goes back to every single insurance company really has their own view, their own product, and kind of their own concerns. And certainly their own line of business. Certainly, climate change is going to affect a lot of property casualty insurers. It just has to. It's really not something that you can pinpoint on for a long-term projection, because I just, the longer a projection, typically in my experience, the longer a projection goes out, the less meaningful it actually becomes, because you just don't know what's going to happen 2, 3, 4 years down the road, especially with, everything that goes on globally. And insurers do, they do take a global view at things, and certainly the capital models vary in, depending on other risk factors. The one I'd say benefit that we have here in the States is we don't concern ourselves with currency risk too often, but anywhere else in the world, that is a real concern. For years, and even through the financial crisis and post-financial crisis, there was a lot of currencies and there was a lot of countries that were in a world of trouble, and actually their bonds were negative yielding. So, it's really tough. I would say certainly for the U.S., I think there's going to be a lot of focus on trade. I think there's going to be a lot of focus on these elections coming up, and then the elections coming up in 2 years. Globally, I think we've got to figure out, a better place with China. And then we'll see what comes next. As COVID, nobody saw a pandemic hit, nobody. And that changed the world that we live in a lot of different ways. So, I wish I could forecast what's next. It's just not my thing.
I understand. Brian, from your seat, thoughts?
Yeah, well, Dean, I think he was asking for green shoots. I was a little troubling.
Okay, I didn't miss it.
Always optimistic. Yeah, I mean, there are challenges, but if you look for in the life industry, right, we were always talking about lower rates was an issue, and we see higher rates, right? So as long, and they are moving quickly, it was more of a gradual step up that we were looking for. But I do think that for those old enough in the room to remember, like this is more of like a traditional economic cycle that we were taught about in school in terms of growth, inflation, right? And so we've seen this switch go on, and that we've been looking for 20 years. And so an increase in interest rates should benefit at some point as long, companies from a pricing perspective. There's changes in the tax laws that are beneficial to life insurance from a product standpoint or ERISA rules. So there are things to be optimistic about. There's a lot of capital within the space. Companies are well capitalized, and there's more capital coming in from third-party asset managers. So with that being said, as this capital comes in, that's something that's positive. It provides companies with an opportunity to shed risk because there's capital to take that risk. If there's something that they don't want to do or they don't want to hold anymore and make strategic decisions, there's someone there to take that. So these are things to be positive about, a little bit more positive about than Dean would probably say, but that's what we see going on.
Okay, I'm feeling better.
Okay.
Maybe Mike, balance this out here. Anything that, with respect to balance sheets that you're looking at that, you're paying attention to? And it's okay if you say no.
Well, the item that's probably getting the most attention, that I see is getting a lot of attention that hasn't been mentioned too much by us so far as a panel, looking at reinsurance. And, most of my work, because we're an Iowa regulator, is on life insurance companies, life and annuity carriers. The use of reinsurance is very large. It's growing. The innovations in how it's being used, what companies are trying to accomplish by using reinsurance, it has evolved a bit. So there can be some risks in there because for companies who do things just on a statutory basis, well, if it's reinsured, sometimes they don't need to worry about it. Well, okay, good. When you get beyond using it just for statutory reporting, for looking at that entity, and you look at overall risk management within your organization, you might want to think about that differently and what the impact could be of reinsurance. I mean, don't ever want to say names, but there's Scottish Re and how that's impacting some companies. There's a real impact. It's not just that money's not there right now, but there's a lot of uncertainty around just that portion of a company's risk management portfolio if they've got an active deal still with that organization, because it's been hung up in court for so long. And there's no real way to model that with just numbers. So that's one that comes to mind that we hadn't really said too much about. But if you're looking at a balance sheet and something that can have a wide-ranging impact on it, that would probably be the first thing.
That's good call out there in terms of calls on capital potentially. I'm going to pause real quick here and just see any questions from the audience to date, what you've heard here and other things on your mind. Okay. We touched on, I guess climate risk came up a little bit earlier. So as a lead in, I think, many would argue, most of the insurers, I guess, that would argue they have a good handle on the climate related risks that they are underwriting or assets they're investing in, and likely feel like they're adequately capitalized. With that being said, there was reference to what happened in Florida and such. But so Mike, maybe I'll start with you. Insurers are probably looking at moderately adverse scenarios. Let's think about the actuarial standards and things of that sort. But how much further into the tail should they be going and thinking about, and what's the NIC potentially looking for at some point?
Okay, I'll start off with the last portion of it, the NEIC portion. For those who may not follow it too closely, the climate, and I'm going to butcher the name of the task force, but the climate task force did issue 3 referrals this year. One went to the group in charge of the financial analysis handbook for regulators. One went to the financial examiner's condition handbook used by regulators. And the other one, the other referral went to the ORSA implementation subgroup. And they were wanting, and this came out of the solvency work stream of the Climate and Resiliency Task Force in particular. And they're looking for, you know, certain tangible steps to make sure that solvency is being monitored with relation to climate related risks. Co-chair of the ORSA implementation working group. So along with Connecticut. So we did have a call earlier this week, I believe it was on Monday, taking up the issue of the referral and what we think should happen with it. And generally, it's being exposed for consideration now, but generally the regulators don't want to have climate called out in particular in ORSA filings. Generally, the regulators feel that if climate related risk or weather risk or whatever a company might want to call it is significant, the regulators feel that they have the authority now to say, hey, your ORSA filing is incomplete because weather related risk is substantial for you and you should be at least disclosing it, modeling it, and talking about it, and it should be in this summary report. Now, that may not be the case for all organizations. Certainly, someone who has exposure to coastal properties on a PC basis is going to have a different exposure than a small life or health insurer in the Midwest. Okay, there's going to be different items there, and what may manifest itself over time on a shore versus what may manifest itself, you know, inland a long ways for just population in general. They could be very different. There could be some impact that relates the two, but it's going to be looked at very differently. So what's the proper level of analysis and disclosure is going to vary by organization. And the working group did not want to get prescriptive about it. It's supposed to be the own risk and solvency assessment, and companies should be able to take that up. And if we as regulators think they're not, we'll push back on it just because we've got the general authority to do that. So that's where that part is going. We may, from the ORSA perspective, make some referrals ourselves. We haven't decided. We're going to wait for comments to the analysis side and to the examination side about best practices that regulators might use on getting to, you know, quantification of the level of risk that a company might have. We may not. We'll see what we get for comments, what we have for ideas, and how that compares to the referrals that have already been made. If there's anything else, we can take that step. But if there's not, then we won't need to. So, you know, that's the NEIC part. And there was another part to your question I've missed, or maybe I covered.
You know, I think it was just sort of the how far into the tail aspect.
Okay, yeah, right. How far into the tail? Well, if I'm looking at it from a minimum standard perspective as a regulator, the ORSA should be for ORSA filing companies, which not all companies are that large, but for ORSA filing companies, your projections of solvency should go over your planning horizon. So if you're a company that has a 5-year plan, maybe a 10-year plan, maybe a 3-year plan, then yes, you should be making your projections over that time frame for your risks. One of them may be climate risk. As far as how far into the tail to go, well, you've got to make something meaningful for discussion internally within the organization and with the board, and you've got to be able to back it up and document it. That's going to be a little different because, you know, earlier today there was a speaker talking about the 1 in 1,000 event versus the 1 in 500 and the 1 in 250. I'm not going to worry about that in particular because opinions of what a 1 in 1,000 event can be are going to vary greatly. It's more about, do you have a handle for the risk in general? Are you discussing the right things within your organization with regard to risks, and that one in particular? How far in a discussion do you need to go? You know, that's, I think, the role of the regulators, making sure that the conversations that are prescribed are taking place, and leave it at that.
All right, great, thank you. Brian, from your seat.
Yeah, I mean, climate change is something difficult to quantify. I think what you see going on, and this is, you know, indirectly S&P's way of maybe trying to capture uncertainty, and I'm focusing on S&P because they cover the largest insurers. They're the ones that's been in the headlines. They're the ones making changes to their capital model. What you see with S&P in terms of their cat risk charges under Currently, they do a 1 in 250 cat charge across all confidence intervals. What they proposed was going up to a 1 in 500 in a AAA. And that's their way of, they realize that the impact of climate change is uncertain and it'll impact companies differently. And somewhat in a, weak attempt to quantify and put a number to it, increasing the tail in what those risk charges. A 1 in 500 is way out there, right? And you're going to get a lot of different results. But I think that's the point, is that there's a lot of uncertainty there. And what does it look like? And what's, the confidence interval around that, those results, right? What does this, and the modeling uncertainty. So what I see going on is that, people are trying to put a number to it, but it's very difficult. And, that will continue. Everybody wants a number on something, but things like this, it's difficult.
This is a risk and opportunity for us, and we haven't talked about opportunities much. So maybe Dean, save us from ourselves here. Anything that you're seeing that, as you think about money being put to work, how it can be opportunistic in all these times?
Did you miss the green and the red thing that went back and forth about 15 minutes ago? Listen, there's always going to be opportunities in placing money into something. When you look at, there's always an offset. And when you look at catastrophe, you can also look at opportunity. Sounds strange, but Florida's going to have to rebuild. What are they going to rebuild? Using infrastructure, using better technology. When you look at a negative, you kind of look at what is the positive that can come out of it. And certainly under President Trump and, the infrastructure bill, there is a lot of companies that get impacted for the good of being able to rebuild stronger, rebuild better. And with that, issues bonds, issue private placement debt. They need funding for things like this. So when you have an infrastructure that is weakened, and you can certainly say climate risk is part of that equation. California a couple of years ago had the energy grid cause one of the largest fires in United States history. What do we learn from that? We've got to build it differently. We've got to build it better. So I think there's always going to be an opportunity when you look at what comes down, goes back up better, and then goes back under various funding scenarios, which becomes available, to various markets. When you look at infrastructure, when you look at global trade, those are all real opportunities because they are really happening. When you look at renewable energy, somebody's putting, and I can say this because I've been fortunate enough to do this I-80 road trip and meet with many insurers out here. Up in New York City, you don't see too many wind farms. Out here, you see a ton of them. But that creates the opportunities because they need to be funded. So, I think when you look at anything that has this, I'll call it climate risk, I actually see opportunity in building that brand new infrastructure to support that.
Great. Thank you. I'll pause again. Any questions from the audience here? We're sort of getting to the tail end of our prepared remarks.
Lots of companies are trying to buy renewables from insurance companies. Here's some of your thoughts of why pensioners and retirees that are receiving pensions feel comfortable. Insurance company providing that service.
So the question for those online was about pension risk transfer and insurance companies getting into the market relatively heavily here. I don't know who wants to take this one.
I'll take a first stab. For pension risk transfer, pension group annuities, I look at it from a number of lenses. I believe your question's coming from one lens in particular, from the pensioner's perspective. How should they feel about that? It's a very good question. Pensions in this country have always had problems. I mean, we can go back to this Studebaker pension back in the 50s. And when that went under because of some jobs that moved from Michigan elsewhere, it created such a vacuum on what people were relying on. Because back then, those people who were already receiving cash were getting it. And then the next oldest, the next ones to receive. And then at some point in time, people, I want to say in the upper 50s and younger, had absolutely nothing given to them. Okay, that was the rule for how to divvy up pensions. And that's part of what led to all sorts of regulation at the federal level coming on down, including ERISA and other items. So we continue to have difficulties from time to time as a society, and this is a society level problem, is providing an income stream, a reliable income stream for retired persons. I don't know that we've got the perfect solution. I do know that something that's very useful is happening is that there's capital being provided to people who are relying on some form of benefit, you know, that has some form of guarantee. Now, I know that people can certainly try to compare the guarantee of the PBGC to the guarantee of a guarantee fund in a particular state. There's pros and cons, pluses and minuses to everything. Looking at it just from that perspective as to who might be a final backstop is a difficult way to look at it, in part because it is a complex adaptive situation. And the way pensions have adapted, the way insurers have entered into the marketplace has added, from my perspective, a new level of benefit or guarantee. Because typically speaking, and this, you know, once again, your view of the world is colored by the models you look through. I look from a regulatory side. I see the major insurance companies in this country being stronger than the major pensions in this country. So the initial benefit I see as being much more strongly guaranteed, the need for a further guarantee being much greatly diminished. To me, that's an enormous benefit. But if you're talking about PBGC versus guarantee funds in various states, it's going to depend upon an individual person's circumstances. If they happen to be somebody who's got a high pension guarantee, the Guarantee Fund Association limits may not look very good compared to what they thought they had from the PBGC. That can be a real issue. To me, that is a societal level issue. That is not a regulatory issue. So I don't want to tell necessarily anybody else what to do from any regulatory perspective, because not mine directly, but from a society level, we need to figure out how we're going to guarantee the income streams and benefits for our older people in our country. And it doesn't just stop with pensions. It also includes that whole thing called Social Security and where the funding level for that's going to be in a decade, right? So there's a complicated issue here. It's very important, but it's societal level, and society needs to make a determination if guarantees need to be adjusted, strengthened, raised, lowered. Guarantees of that sort from time to time do change. I mean, it wasn't that long ago FDIC changed their guarantee levels on individual depositors and things of that sort. So society will adjust, but that is an issue that's getting current press, and it's important. But I do see it being a complex issue, and you got to look at it from a holistic perspective of the likelihood of needing a guarantee goes down considerably for the insurance company because they're much more strongly capitalized. They're repricing the benefit stream at the time that they're, you know, effectuating the deal to close out the pension. Makes it to me, it's a very compelling argument, but I'll leave it at that.
Any other questions? We have about 2 minutes. Anything from the panel here? Any closing thoughts, things that we didn't talk about that you hope we would?
Okay, I'll take another shot. What the heck? I can stand back and call my shot here. You were asking moments ago before we got to the questions about opportunities that we might see. An opportunity that I think I see, particularly for those who are working around capital models for insurance companies and insurance organizations, those who get into the model, those who modify it, those who update it, those who use it, the output from the models, those who are most well informed are going to be those who are most likely able to adapt to change. The next crisis is not going to look like the last crisis. That's never been the case. The next beautiful sunshine and the markets are all up is not going to look like the last one. There's still going to be people saying, well, it's never going to go down again because this is different this time. I mean, this time is always different, yet it never really is. There's going to be another crisis after the one that we're in now. Those who have a functioning model are going to be more apt to be able to adapt in the moment and at the time to whatever the change or stimulus might be in the future. And to me, the capital models are extremely important, whether you're using Solvency II or RBC or S&P or BMA or any of those standards.
Great. Thank you. Brian or Dean?
Yeah, I mean, I'll say is we're talking about opportunities, the changes that we are seeing in the capital models or how companies manage capital, is creating opportunities for more strategic capital management and seeing the benefits for it. So as we see capital models get more granular, I'll again go back to an S&P capital model that they're switching from one C3 charge to disaggregating that into 3 separate charges: interest rate risk, lapse risk, and longevity risk, right? It creates an opportunity to more finely manage, refine your capital management strategies and see the benefits from that. Whether it's more granular asset class charges, right? You need to be more actively engaged and up to date on your capital management strategies, and there's an opportunity to be more efficient, and think about how you use things like reinsurance or the capital markets to fund and take risks. Like I said before, there's a lot of capital out there that needs to be deployed. You need to be smart about your sources of capital and view it through different lenses, whether it's debt, equity, hybrids, reinsurance, how you manage that capital, how you finance the risk you're taking. There's a lot of opportunities for improvement out there, and efficiencies can be gained.
Great. We got about 30 seconds. You get the last word, Dean.
Yikes. Coming out of the financial crisis, the one thing that I think everyone has learned about modeling is you stress your models. You stress them under multiple scenarios, whether it's interest rate, whether it's market volatility, and the band of which you stretch it and really stress your model. Models are great for a point in time, but tomorrow could be a completely different environment. So I think, the panel will agree that largely you want to have a model that's flexible enough to stretch it, stress it under various situations that can happen. And I think the more robust that stress test is, the better apt you'll be able to absorb kind of what's coming next that nobody can see. So I do think out of the financial crisis, that is actually, something that came out that's actually very beneficial. Is there's multiple triggers you can look at to actually stress your model to hopefully at least avoid a full on, punch in the face on the next cycle.
Great. No, thank you. Well, this was a very enlightening session in terms of really trying to understand what's going on in the capital models and the markets right now. So if you wouldn't mind, join me in thanking our panelists today. In just a few minutes, we'll have our next session.